Okay, let's dive into this. Welcome to the Explainer. Today we're taking a really fascinating look at the hidden mechanics of a system that pretty much all of us rely on, but honestly, very few of us actually understand. Insurance is usually seen as this simple transaction, right? You pay a premium, something bad happens, you get a payout. Easy. But as our source material reveals, insurance is a strictly regulated safety net. It is absolutely not a casino. There are these rigid, textbook principles that govern every single claim. And understanding these rules, well, that's literally the difference between being fully protected and finding yourself completely exposed.
So here's how we're going to break it down today. First up, trust and vested interest. Second, making you whole again. Third, shared costs and root causes. Then we'll cover types of life insurance, and finally, wrap it up with marine and fire policies. We're going to break down these complex mechanics into some really digestible scenes.
All right, let's jump right into Section 1, Trust and Vested Interest, the real foundation of your coverage.
You see, every single insurance contract out there starts with one massive fundamental assumption: honesty. Without it, the whole system just collapses before the ink is even dry. Picture this. Imagine a guy named Mr. Chantanou. He sits down to fill out his life insurance medical form, right? He gets to the medical history section, but he purposefully hides a heart surgery he had a few years back. Fast forward, and sadly, Mr. Chantanou passes away. His grieving family files a claim, totally expecting their financial safety net to activate. But when the insurance company investigates and the truth comes to light, a giant red X comes down over his family's compensation claim. So why the giant red X? Well, it all comes down to the principle of utmost good faith. The ruling here is incredibly strict. The claim gets rejected outright. Basically, this principle demands that both the insurer and the insured disclose all material facts clearly, completely, and correctly. You just can't hold anything back. If you fail to provide correct information, it completely voids that safety net. Period.
When you think about real-world policy providers, places like New India Assurance or the Life Insurance Corporation of India, they are managing just incredible amounts of risk. These massive financial institutions can only function smoothly when both parties are acting in completely good faith.
Building right on top of that foundation of trust is our next concept. Just picture a businessman proudly standing in front of his very own massive warehouse. He's allowed to insure that building for one specific reason. He has a direct financial stake in its safety. We call this insurable interest. You actually have to suffer a direct financial loss if the insured subject is destroyed. So, no, you can't just buy a fire policy on a random stranger's house down the street hoping to make a quick buck if it burns down. The existence of the property has to give you a financial benefit, and its destruction has to cause you a real financial loss. Moving on to Section 2, making you whole again, the math of recovery. Now, what's really interesting about this is how those payouts are actually calculated. Let's look at the actual numbers. Imagine you have a property worth 2 lakhs, and it gets damaged by fire. Let's say the fire causes exactly a 1 lakh loss to the structure. While under the strict principle of indemnity, the insurance company scales their payout to perfectly match the damage. They pay out exactly 1 lakh. The whole goal of indemnity is just to bring the owner back to the exact same financial position they were in right before the fire happened. No more, no less. You absolutely cannot use a loss to turn a profit.
But hey, what happens if the situation totally changes after a payout? Let's walk through a little mini mystery together. Step 1, Mr. A's motorcycle gets stolen. Step 2, he files the police report and his insurer pays his full claim. Awesome, Mr. A is made whole again. But wait, Step 3, the police actually managed to recover the stolen motorcycle. So who gets to keep the bike? The ruling here is pretty fascinating. The police actually hand the recovered two-wheeler directly to the insurance company executive, not Mr. A. That's the principle of subrogation in action. The minute you're fully compensated for a loss, the ownership rights of that damaged or recovered property instantly transfer over to the insurer.
All right, that brings us to Section 3, shared costs and root causes, investigating the claim. So what if a disaster causes a 1.2 lakh loss on a single property, but it's actually covered by 2 different insurance companies? The owner doesn't just get to claim the full amount from both and double their money. That's a huge no-no. Under the principle of contribution, the loss gets proportionately split. For example, if Ms. Sayali insures her property this way, Company T might pay 40% of the loss, and Company R pays 60%, based on the fraction of the total property value they each covered. They just share the burden fairly. Now picture Mr. Jant. He's standing in his kitchen and suddenly, boom, a short circuit starts a fire. Does he just stand back and passively watch his house burn down simply because he knows he's got insurance? Absolutely not. Under the principle of mitigation of loss, he has to actively grab a fire extinguisher and try to put out those flames. It is literally your legal responsibility as the insured to take all possible measures to control and reduce the damage when disaster strikes.
And then we run into the causa proxima dilemma. This basically means finding the proximate or nearest cause of a loss. Imagine this scenario. Thieves break into a house, steal a bunch of valuable stuff, and then, right on their way out, they set the house on fire. The homeowner files a claim, but their policy only covers theft, not fire. So what's the ruling? Well, the insurer will compensate them for the stolen goods because that loss was directly caused by theft. But the fire damage? That gets rejected. Even though the thieves were the ones who started the fire itself wasn't the nearest covered cause under that specific contract.
Let's move to Section 4 and see how this builds into real-world applications. Types of life insurance, securing the future.
Shifting gears from the strict rules of the game to the actual coverage options you can buy, imagine a family portrait safely morphing into a growing investment chart. You've got several tools to make that happen. Whole life policies, for instance, cover a person for their entire lifetime. Term insurance, on the other hand, covers a very specific period, usually with really low premiums. Then you've got endowment policies that pay out the sum assured plus a nice bonus, and money-back policies that give you regular percentage payouts during the term. There are even child insurance plans that you can start right from birth, building up savings that gracefully transform into funding in adult streams, like, finally putting on that college graduation cap.
Finally, we arrive at Section 5, Marine and Fire Policies Protecting Commerce. And this brilliantly illustrates the sheer scale of marine insurance. Imagine a giant cargo ship navigating through some seriously stormy ocean waters. We're talking about a massive network of protection here. It covers the vessels themselves, the specific voyages they take, and the vital cargo lines crisscrossing these incredibly complex global routes. A business can take out a voyage policy for one specific trip, a time policy for a set duration, or even a fleet policy if an owner needs to insure an entire group of ships all at once.
But what about doing business on solid ground? Fire policies offer some incredibly nuanced options for businesses to protect their fluctuating stock. You have a valued policy, which locks in a pre-agreed value for things that are super hard to price, like artwork or sculptures. Then there's a floating policy, which is just perfect for a business owner whose goods are constantly moving across multiple warehouse locations. There's even a reinstatement policy. With this one, instead of just handing the business owner a check for their ruined property, the insurer actually steps in and undertakes the work to replace the property entirely.
To close out our scenes today, let me paint a picture of a very specific type of commercial cover. Imagine a massive warehouse packed to the ceiling with commercial product boxes. Suddenly, the specialized automatic overhead water sprinklers just accidentally pop open. They start raining water all over the inventory. There's no fire, there's no smoke, it's literally just a mechanical failure. Well, this is exactly what a sprinkler leakage policy is designed for. It covers accidental water discharge that is completely unrelated to an actual fire event.
So, what does this all mean? The absolute crucial point here is that insurance is way more than just blindly paying premiums and hoping for the best. It's this incredibly intricate system built on utmost good faith, indemnity, subrogation, and finding that proximate cause. It demands honesty and proactive behavior from us. So, I want to leave you with a question. Are you truly protected by your policies, or are you unwittingly breaking the fundamental rules of the insurance game? Fully understanding these foundational principles empowers you to be a much smarter, safer policyholder. Thanks so much for joining me for this explainer, and keep learning.